Welcome back to 5 Crucial Retirement Planning Concepts, Part 5. Now here's a review of our first 4 videos. 1. You must strategically plan a constant stream of distributions that will keep paying you for the rest of your life. So 2. You should move some of your investments into green money with safe and steady growth so you don't risk any loss in a major market decline. And this will allow you to 3. Give yourself enough income prior to age 70 without Social Security payments so that after age 70 you can receive 76% more per month in Social Security for the rest of your long life. And 4, you or your kids would want to move maybe 50 to 100,000 of qualified funds into a hybrid annuity or life insurance plan so that if you need long-term care, your investment will now be worth $150,000 to $300,000 overnight, which protects both your assets from depletion and gives you a higher quality of life in your final few years. Now in Part 5, we're going to look at some specific green money alternatives that will help generate the kind of growth that you want without putting any of your money at risk. So here's our goal. How do you get moderate growth with minuscule risk? Well, let's first review the 3 colors of money from Part 2. Red money is in the stock market. It can go up or down suddenly without warning. Yellow money is in the bank, passbook accounts, CDs, money markets. They're very safe, but they don't earn squat. Green money are alternatives in the middle, giving you a decent upside with no risk of downside. Now, traditionally, people in their 60s start shifting mutual funds and stocks into bonds, thinking that they will somehow provide the slow, steady, safe growth that they want in retirement. However, I believe that each of the green safe alternatives I'm about to suggest to you are better than bonds. Why is that? Well, over the past few years, we've seen historic lows on interest rates. That's the first problem with bonds. Very low rates of return. CDs pay 1.25%, 10-year treasuries pay only 1.6%. Well, that's bad enough, but do you expect interest rates to go up or down in the next 10 years? Well, up, of course. They can't go down any further. And when interest rates rise, bond values go down fast. So that traditional safe harbor is not so attractive anymore. So what are some green alternatives that are better than bonds? Well, I'm going to list out 6 of my favorites, from the higher returns to lower ones. And the ones you like best will be based on your personal goals, your risk tolerance, and your time horizon. So here they are. Here are the brass tacks goodies you've been eagerly waiting to hear about all this time. 6 different ways to achieve moderate growth with minuscule risk. Option 1 provides excellent moderate growth with minuscule risk. You'd invest a minimum of $15,000 for 6 to 8 years, and you'll get back a 65% gain, which is about 9 to 10% annually. This has no risk from the stock market, interest rates, or global instability. Most people don't even know it's available, but I can help you enroll. This is an option I'm investing in myself. Option 2 provides you with a 7% gain over 5 years or an 8% gain over 10 years. The minimum for this one is $25,000. For example, if you deposit $126,000, you will start getting paid $1,500 every month for 120 months, which is a total of $180,000. Pretty cool, huh? This is the option I plan to invest in soon after I retire. I think it's the best option for closing your income gap between 65 to 70 as you wait for your Social Security payments to grow 8% higher every year. Next, option 3 is an excellent choice for somebody, I think, in their 50s. You'd deposit any amount above $5,000. You'd wait 10 to 14 years, and during that time you would be earning 5 to 7% annually. And here with option 3, you can actually lock in a lifetime income guarantee so that whenever you start turning on payments, It will continue to pay you that amount for as long as you live, even if you go past 121. This plan is especially attractive if you have a large 401k and expect to have big required mandatory distribution problems when you turn 70 and a half, because you're going to have to start paying taxes on those withdrawals. Option 3 can help delay that problem by extending your tax deferral out another 10 to 14 years past age 70 and into your 80s. Now, option 4 is what we discussed in our last video. It involves transferring some qualified money into a long-term care hybrid annuity or life insurance policy that triples its value for long-term care expenses, and then it comes out tax-free when you spend it for that purpose. And then when you pass away, whatever remains goes to your heirs tax-free. I plan to invest about 50 grand into this option very soon. Now, option 5 is for the extremely conservative person who wants to keep all their money in the bank and needs absolute guarantees in order to make a move. Well, a MYGA is a multi-year guaranteed annuity. And as of when I'm recording this, it offers a 5-year, 3.15% annual rate, and that is 100% guaranteed. Option 6 is also for a person who wants an FDIC insured CD, but these are market-linked CDs. They're sold by large banks such as Deutsche Bank with a term of 5 to 7 years. If a particular bucket of commodities does well during those years, you can potentially earn as much as 7%, but those rates are not guaranteed. Now, this spread of 6 options offers something for everyone regardless of their risk tolerance level. Each of these 6 options are green money alternatives to yellow money that has almost no yield and red money that has volatile, unpredictable yields. Most of these have a fairly short time horizon of only 5 to 10 years. So as you look at this list, which 2 of these options look most interesting to you? Well, let's briefly review our paradigm shift, how we move away from an accumulation plan to a distribution plan. By using 1 or 2 of these alternatives, you'd be shifting some of your volatile red money into steady, dependable green money. Now, current stock and bond portfolios are only hoping to earn about 6%. But now you know some ways to invest in safe and secure alternatives that will provide that much or even better without any market risk, so that your income streams will last for at least 30 years. Well, why would you do that? Because the right side of this diagram simply makes good sense. You know you simply can't take a chance on another 2008 surprise that could end up delaying your retirement plans for another 5 to 10 years, right? With less volatility, you'll sleep better and you'll have a lot less to worry about every day. So I hope by now you understand how all of these 5 concepts work together to help you build a stronger and more secure retirement plan. So of these 5 concepts, which ones are most important to you? Which ones are the highest priority for your family based on your specific wants and needs? What do you think would be the best plan of action for you to start now? Okay, friends, this is the call to action. Now that you've learned all this important information, what are you going to do with it? Feel free to call my cell. Feel free to send me an email. Just make sure you spell Johnson with an S-E-N. And just let me know which of these 6 investment options you like the best. Go ahead and ask for a specific quote based on a certain amount that you're thinking about investing and what your time horizon is. And let me know whether these funds are going to be qualified or non-qualified funds. Sound fair enough? Well, that concludes part 5 on moderate growth with minuscule risk. And it concludes our 5 concept series. If you found this helpful, please share these links with your friends by email, Facebook, and Pinterest. Spread the news on how they too can retire risk-free. I look forward to speaking with you soon so that you can take your next step to actually do that and retire risk-free. So long.